Hello friends, welcome to another video lesson where we will be discussing the concept of expenses and assets, and instead of going through the theory first, I would like to take you through an example and we would discuss the theory within while discussing the example itself. So for example, let us say you need a machine in your business for production process. You need a machine in your business for production process. So let us discuss scenario one. Scenario one is that you can get the machine on rent. You can get the machine on rent for rupees, the rent is rupees 5,000 for a year. So this I have drawn over here is a timeline, and the numbers over here represent years. So these are years, and in this timeline the period which I have marked from here to here is the current accounting period or the current year. So say we get the machine on rent for rupees 5,000 in a year. We can plot this transaction on this timeline. So at this point we enter into an agreement with the owner of the machine to rent the machine out to us for rupees 5,000 a year. So at this point, we enter into an agreement with the owner of the machine to rent it out to us so that we can use it for this period, for this much period. And for using the machine for this period, we will have to pay a rent of rupees 5,000. And at this point, at this point, we will no longer have the right to use this machine anymore, and we will have to either renew the contract or let the machine go. The owner will either take back the machine, or we will have to either renew the contract, and for using it for the next period we'll have to pay additional rent. So let us analyze this transaction. So in this case we are paying a cost of rupees 5,000, and we are getting a benefit. Let us discuss what benefit we are getting. We are getting a benefit of using the machine for 1 year, or the current accounting period. This 1 year is the current accounting period. So if we see, at this point we did not have to pay anything. At this point no payment was made, no payment. And the payment of the rent was actually made at this point when the machine was used for 1 year. So you enjoyed a benefit of using this machine for this period, and at the end when you enjoyed the benefit, you made a payment of rupees 5,000, which was the cost of the benefit that you enjoyed by using the machine. So this is pretty simple. You paid rupees 5,000 and you enjoyed the benefit of using the machine for 1 year. And now the most important part over here, that we see that this cost that you have paid, this amount that you have paid, is actually giving you benefits which are consumed within the accounting period. This cost or this outflow of money is giving you a benefit. This outflow of money is giving you a benefit which is being consumed and enjoyed in the current accounting period itself. The benefit does not go beyond this mark. This is the end of the current accounting period, and the benefit does not go beyond this mark. It does not carry over to this period. For using the machine in this period, you will have to pay either additional rent, or you will have to make some arrangement with the owner of the machine. But in this scenario you can pay rupees 5,000 and use it for only this period. So here the benefit is enjoyed in the current accounting period and is expired with the expiry of the current accounting period. So this kind of benefit is known as an expense. So an expense is a benefit which you get by paying something, and that benefit is expired or is enjoyed within the current accounting period. So What are the characteristics of an expense? You can enjoy the benefit enjoyed or expires within the current accounting period. The benefit cannot be carried forward. Current accounting period. And in no case you get the ownership of the machine because you have taken it on rent. And for this benefit you need to pay something, which we have seen that we have paid rupees 5,000 for the same. Now let us come to scenario 2. This was scenario 1. This was scenario 1, which is which we have told is a case of an expense. And let us come to scenario 2. In scenario 2, it is written that we buy the machine for rupees 50,000, and the estimated life of the machine is 10 years. We buy the machine for rupees 50,000 and estimated life of the machine is 10 years. So at this point you are buying the machine, so you are paying rupees 50,000. You are paying rupees 50,000 at this point, and you are gaining a right to use the machine for this much of time, for 10 years. You will be using the machine for 10 years after paying this much cost. So if we if we divide the cost over the useful life of the machine is 10 years. If we divide the cost of the machine by the useful life, that is, if we divide 50,000 rupees by 10 years, so we will get this 0 and this 0 cancels out. We will get rupees 5,000 divided by year, so rupees 5,000 per year. So if we divide this cost over the useful life of the asset, we can obtain an idea, we can gain an idea that per year cost of the machine would be 5,000. I hope you get my point. Per year cost of the machine would be 5,000 for the period that you use it. And at so the per year cost will be rupees 5,000. So let us see what benefits would you get by performing this transaction of buying the machine. Let us see the benefits first. The benefits would be right to use for 10 years. And one more additional benefit you are getting out here, that you are getting the ownership of the machine. You are getting the ownership of machine. So now in this case you are becoming the owner of the machine, which was not there in the last case. So you can once you become an owner, you can do anything with it. You can either sell it off at this point. After 3 years you don't need it, technology has advanced, you need an advanced machine, you can sell it off. You can do whatever with it you want, because you are now the owner of the machine. So let us see the timeline now and what happens at this point. Let us assume 1 year has passed, this period has already passed, and we are now standing at this point. So what happens at this point? If we analyze the situation at this point, we have already enjoyed benefits worth rupees 5,000 from the machine, because you have used it for 1 year, and cost for 1 year would actually be the cost of benefits, you are going to enjoy from the machine, because you are paying this cost to enjoy to use the machine, to enjoy the benefits you are going to get from the machine. So after 1 year you have from this 50,000, after 1 year, at this point you have already enjoyed benefits worth rupees 5,000. So at this point your machine will be worth rupees 50,000 minus the benefits which you have enjoyed, that is rupees 45,000. So at this point, at the end of 1 year, your machine will be worth rupees 45,000, because you have already enjoyed benefits worth rupees 5,000. So this part of the cost of the machine which you enjoyed in the current accounting period, the cost of benefits which you enjoyed in the current accounting period, will be treated as an expense. And at this point, when you actually purchase the machine, it becomes your asset, because the characteristics for an asset are, you need to get benefits from it in future. You need to get benefits from it in future, benefits in future, plus you need to be the owner. You should have ownership rights, and you should be able to get benefits from it in future. Both conditions have to be satisfied, otherwise any cost or any property will not qualify as an asset. So at this point of time, when you buy the machine, you expect to get benefits from this machine in the future, and you also become the owner of the machine, so this machine becomes your asset. But after 1 year, at this point of time, what happens? Let us analyze the situation after 1 year. After 1 year, what happens? You have already enjoyed benefits worth rupees 5,000. So benefits for rupees 5,000 enjoyed. So this will be treated as an expense for the current year, because the benefits you have enjoyed has been expired in the current accounting period. So this cost of rupees 5,000 will be called an expense, and there is a name for it. It is called depreciation. In accounting language, it's called depreciation. So and after 1 year, you are left with benefits for 9 more years. You are left with benefits for 9 more years. You can enjoy the machine for uh, this point to this point in future. So 9 more years of benefit are still left with you. They have not yet expired. You can enjoy this benefit in the future. So now your machine is cost. Now the value of your value asset becomes original cost of asset, which was rupees 50,000, original cost of asset minus benefits already enjoyed, which is 5,000. So 50,000 minus 5,000, it comes to rupees 45,000. So this can also be called the written down value of the asset, or the value of the asset after 1 year. And gradually this will become 40,000 over here when benefits worth rupees 5,000 are enjoyed, and then 40,000 over here, then say 35,000 over here, and at this point it will become finally zero, because 5,000 worth of benefits will be enjoyed every year, and the value of asset will decrease by that point. So I hope I could make you understand the concept of expenses and assets. And let us wrap it up. An expense is something for which you pay a cost, and you receive some benefits, but the benefit expires within the current accounting period. The benefit expires within the current accounting period. The benefit is not carried over to the next accounting period. But in case of an asset, you pay a cost to get benefits in future. You pay a cost, you have paid 50,000 over here to get benefits in future, and you get the ownership rights to some property. You also get the ownership rights to some property, where both the conditions are satisfied. The expense that you made and the property you gained is qualified as an asset. So, and the value of the asset is actually written off or depreciated during the timeline of the useful life of the asset. Let me repeat it once again for a clear understanding, that at this point when you bought the asset for rupees 50,000, the value of the asset was actually 50,000. But when you use the asset for this period, when you already use the asset for this period, and at this point of time you have already utilized benefits from the asset worth rupees 5,000, and I got this 5,000 by dividing the cost of the asset by its useful life. The cost of the asset was rupees 50,000 and its useful life was 10 years. So if you divide 50,000 by 10, you would get 5,000 a year, and logically we can say that cost of using the asset per year would be 5,000. So at this point, when you are standing at this point, benefits worth rupees 5,000 has already been enjoyed, and you are left with 9 more years of usage of the machine. So you can, at this point, you are standing with the machine which can give you benefits worth rupees 5,000 for 9 more years. So 5,000 into 9 years, you get benefit worth rupees 45,000 in future. So at this point your asset will be worth 45,000. So the value of the asset is nothing but the expected amount of benefits that you expect to receive from it in the future years. I hope I could make you understand what I'm trying to project out in this video, and we will continue with incomes and liabilities in the next part.